Good afternoon, students. Welcome to Accounting Module 1. This is Soma Kambode. I will be your tutor for this module, Accounting Module 1. That is my contact details and my email address. I'm going to take you through this module. Welcome to Accounting Desk, Accounting 21. All students doing this module are encouraged to be more practical, as practice makes more perfect. So I'm encouraging everyone doing this module to do more practical activity, especially in your modules that you're already given to you. So try to attempt all possible activities possible so that you can prepare yourself for the final exam. The accounting rules and principles are very important, especially when you are going to solve all problems in this module. So when I'm talking about accounting rules and principles, I'm talking about the elements of accounting, which are assets, liabilities, capital, income, and expenses. As long as you know those elements and you know how to treat these elements, for example, let me give you an example. For example, assets. When an asset is brought into a company or into a business, they always increase on the debit side and they decrease on the credit side. As long as you know those rules, then you are good to go. All right, without wasting much of your time, let's go through the module together. So pay attention. First of all, we are going to do a few things on adjustments for final accounts, and also as well as depreciation and disposal on non-current assets. Let's kick off by doing depreciation. First of all, before I explain to you why do we need to depreciate for our non-current assets. I think it's best if I can start off by defining to you what is depreciation. When we are talking about depreciation, when you buy assets or non-current assets for your business, they lose value over a period of time. So that loss in value is what we call depreciation. So depreciation is an estimated loss in value of a non-current asset over its expected working life. It's charged as an expense to an income statement every year. So now I'm going back to the previous slide to explain why do we need depreciation. In accounting, the reason why we need depreciation is because of prudence principle. Like I said already in the previous slide, I said we need accounting. You should know the principles and the rules of accounting. One of the principles of accounting is stating that we must not overstate our income. In other words, when we buy assets for our businesses, they bring in return to our business. All right. So the moment we start using these assets to generate further income for the business, then we are more concentrating on the income that is being generated, but we forget the fact that the more we are using these assets, the more value of this asset is also going down. The moment we don't concentrate on this, we'll end up overestimating our income and then underestimating our expenses. Because of prudence principle, an expense is needed to record part of the value that has lost on our non-current asset in the specific financial period to ensure that our profit at the end of the day is not overstated, and that is the prudent principles. Depreciation is also needed to ensure that the value lost on our non-current assets due to its usage over a period of time is also matched with the income that is going to generate, because now we are talking about another principle, which is matching concept. Because now if we are generating income through using non-current assets, it means the asset is losing value, so we have to match our income with the expenses which is accumulating through the depreciation. That is what the matching principle is stating. Right, we go to provision for depreciation. If you don't understand what is provision for depreciation, so the total value lost of a non-current asset since it was bought, we now subtract it from the cost price to ensure that the value is not overstated. So now, provision for depreciation means the day we are going to acquire this non-current assets. If, for example, this non-current asset has been used for a period of time, we have to subtract the value that it has lost through the time we have been using this non-current asset, and that is the provision for depreciation, and that is the prudent consent again. All right. I already explained to you what is depreciation. Now I want us to talk about book value. What is the book value? Book value is the cost price. How much did you buy that non-current asset for, minus or less provision for depreciation. So let's say, for example, you bought this let's say, for example, a vehicle. The vehicle was bought for, let's say, for example, 100,000 Namibian dollars. Okay, that was 2020. Okay, so if in 2022 this value won't be the same anymore, of course the value will be gone down. Let's say, for example, this vehicle lost its value to say the depreciation that took place in 2021 was, let's say, for example, 5,000 depreciation, and then for 2022 it will be another 5,000. Then obviously the accumulation provision for depreciation will be, depreciation will be 10,000. So the book value for 2022 won't be 100,000 when you acquire these assets, but it's going to be 100,000 minus 10,000. That is going to be now 90,000. That will be the book value. That is just an example. So minus 10,000, then it's going to be 90,000. That is the book value of the vehicle in 2022. All right. What causes depreciation? There are so many factors that can cause depreciation, such as wear and tear, maybe the rust or rot, or an asset just got old. Economical reason, or maybe the asset that are bought in 2010 is no more in fashion, is no more in use, or it's outdated. People have replaced. Let's say, for example, machinery that used to be in usage in 2020 is no more the one that is going to be used in 2021 or in 2020, because new technologies are coming in with new latest advanced machineries and so on. Passage of time, like a lease on a building for a set number of years, depreciation, value of mine, oil, well, and over a time period, etc. Those are some of the causes of depreciation. What are the reasons for depreciation? Already, the reason for depreciation, we have already highlighted them already in the other previous slides. Like I spoke about matching concept, where a business calculates profit or loss, income, benefit earned through the use of assets during a financial year must be matched against the expenses incurred, value lost from using these assets. Okay, or prudence, to ensure that profit are not overstated and non-current assets should not be overvalued. The value of non-current asset decrease from year to year over the useful life of this asset. So the value in the books must be the book value, as I've calculated this. Okay. Now we are moving on to the next topic, which is we want to differentiate between capital and revenue received and capital and revenue expenditure. Okay, what is capital receipt? This is the money that we get from selling our non-current asset. So let's say, for example, I am selling off my machinery, my equipment, and so on. So that income that I'm generating from the sales of this non-current asset is what we call capital receipt. And then revenue receipt, this is the money we receive from trading activities such as selling or rendering services to our clients or to our customers. As example, cash sales, rent income, rent received, etc., etc. And then capital expenditure, this is when the business spend money to buy or add value to our non-current asset. What do I mean by this? When I'm spending money for the business to buy more equipments for the business, to buy more machinery, to buy more land and building, that is capital expenditure. Or when I'm trying to renovate or add value to the existing non-current assets that are already in my business, that is capital expenditure. Okay. Revenue expenditure, this is when money spent on expenses needed for day-to-day running of the business. For example, if I have to pay salaries and wages for my employees, they are the people that are working in my business, so they are I have to spend on them, and then repainting the building, telephone, wages, advertisements. These are examples of revenue expenditure. Okay, moving on. Effects of depreciation on non-current assets. What are the effects of depreciation to our non-current assets? One, there are two. Depreciation reduces the value of our non-current assets. Obviously, because these assets have been used for a certain period of time, the value won't be the same anymore. That's why the value of our non-current assets have to drop as a result of depreciation. It matches the loss in value of non-current assets to the benefit gained by this asset in a particular year. And that is still the matching concept. Okay. There are many methods of depreciation. But before we choose the best method which we are going to use, because every business, because of consistency principle, every business have to adopt. We don't need to change methods of depreciation from time to time. We have to stick to one method. So what are the factors for me to decide in my company or in my business, this is the method that I'm going to adopt? We look at the following factors. Number one is how long will the asset last? Okay. Number two, we look at how much an asset will be sold for when we are to put it on sale, for example. And also number three, we also look at the type of assets. And number four, we also look at how can use be measured. Okay, these are the factors though. Now, depending to the condition that you find yourself in your business where you are, then you're going to choose the method that is suitable for your business, and then you should be adopting this method throughout. You don't need to change this financial year, you're applying this method, and the next year we are going to apply. We have to be consistent throughout. Okay, now when we are going to calculate for depreciation, we usually calculate our depreciation on monthly basis, with percentage, of course, and looking at the and also the financial period, calculating the depreciation of each asset for each financial period separately. Dates are very, very important. Dates of purchase and sales should be well noted to determine the number of months the asset should be depreciated for that specific financial period. And I'm going to repeat the dates, either the dates we have bought these non-current assets or the dates we are going to sell these assets should really be noted down so that we will know how we are going to calculate, so that we can really give a true value of our depreciation. Otherwise, if you don't pay attention to the dates, then we are not going to get the true figure for our depreciation. The first method we are seeing here is the straight line method, or sometimes we call it fixed amount method or cost price method. So the formula is there. There are two, depending to the information you are given. Let's say, for example, you are given the cost and the percentage alone. Then you're just going to say the cost of the vehicle, which is 100,000, and the percentage that is given to you, which, for example, is 20 20%. So when we are going to calculate this depreciation, what do? We just say the cost price, which is 100,000, multiply by 20% over 100, then you get the answer. I'm sure this is going to give us 20,000 Namibian dollar. This is the depreciation for the vehicle for that year. That is the straight line method. But in case where you are given the cost price and the residual value, let's say for example, the residual value is given to you, let's say the cost price is 200,000 and the residual value maybe you are given to say 10,000, and then the number of years this asset is supposed to last, for example, let's say 5 years. So this is how you're going to define your depreciation. Then you're going to say 100,000 minus 10,000, that is 90,000, divided by 5, the number of years. Then you're going to get which figure? I don't know. I can't get this. The calculator I should get here, 90,000 divided by 5, then we are going to get 18,000. So 18,000 will be my depreciation for every year. We say it's fixed amount method because every year, so this is for 5 years. It means in 2021 it's going to be 18,000. 2022 is to 18,000. So 22, 23, 18,000. 2024 is 18,000 still, and 2025 is 18,000. So when you end up all this 18,000, you are going to get 100,000. So the asset is gone. Okay. Then we go to the reducing balance method, or sometimes they call it diminishing balance method or book value. So what is the formula for this? It's not the same as the one for straight line method. The information will be given to you in a trial balance that is already prepared. Like for example, the amount this asset was bought for. I'm sorry to use the same amount, 100,000. I think it's easy to understand. And then the provision for depreciation will be given to you. Okay, let's say for example the provision for depreciation is 20,000 Namibian dollars. So they are asking you, and the rate also, let's say 20%. Okay, calculate the depreciation for this company using the diminishing balance method. So we are going to say 100,000 minus 20,000. Then we get the answer, which is going to be 80,000. Then from this 80,000 is where we are going to convert to 20% over the 100. Then we are going to get the answer. I'm still going to use my calculator here. 80,000 multiplied by 20 over 100. Then 16,000 will be the value for depreciation. So that is the way forward. That's how it's done. Okay. Then those are the main methods that are usually asked a lot in our examination, either straight line method or diminishing method. Now, this is going to be disposal account. To make you understand better, I think I need to go to the next slide. See, when we are disposing of an asset, disposing means to sell an asset. First of all, when we are going to sell this asset, we need to state how much this vehicle was bought. For example, the correct date, the vehicle cost price of the vehicle that we are going to sell, because many a times we are given so many different types of vehicle, but it doesn't mean that we are going to sell all of them, but we are going, that specific vehicle that we are going to sell is the one which we are going to record the cost price for it, and then we are going to on the debit side, because assets, when they are bought in the business, they increase on the debit side, like I said, the accounting rules. And then later, the depreciation that took over on this vehicle is how much total depreciation for the asset, the one in red on the credit side. And then how much are we going to sell this vehicle for? That you can see bank cash or trade receivable, is it on credit or whatever, the amount also. Then if we are getting the difference on the credit side, then that means we have made an income statement loss on disposal. If the answer is going to be on the debit side, then that is income statement profit on disposal. So you can already see. So the only three things that are recorded here: how much have you bought this vehicle in the first place on the debit side, and then on the credit side we record how much we are selling this vehicle for, and also the depreciation that took over. Then we can get the difference. If the difference is coming on the credit side, then that is the loss. If it's coming on the debit side, then that is the profit on disposal. Okay, so depreciation and disposal of non-current asset in financial statement. Income statement: total depreciation charged for the financial period is included under expenses. So just for you to know, depreciation is an expense and is recorded in the income statement under expenses. Any profit, income, or loss expense on disposal of non-current assets is also included, called Reg 3. Statement of financial statement: total depreciation to date since acquisition of non-current assets is subtracted from its cost price, so that at the end of the day in our statement of financial account, usually called the balance sheet. In the past we used to call it balance sheet, but now we don't call it such. We have a new name called financial position. We have to give a true value of our non-current asset. Don't just record the cost price of an asset. You should subtract the depreciation so that we can give a true value of the book value of the assets. Cost price and depreciation charge for the disposed non-current asset is subsequently subtracted herein as well, like I said. Now here we are going to prepare preparation of financial and principles of financial statement. When we are going to prepare financial statements, we need to do adjustments. Adjustments are made for preparing a financial statement so that they reflect the true figure of the specific financial year. The expenses or income shown in the income statement must be adjusted so that they relate only to a period of time covered by this account. Matching or accrual principle: expenses and income shown in the income statement should be adjusted so that only the current financial period information is reflected in this account. Any income or expenses related to other period is deducted, and any amount outstanding related to the current period is added. I want to pause a bit here. We are talking about adjustment. There is where these things of prepaid expenses, accrued income are coming in. So just for you to know that when we are dealing with this thing, let's say we are only recording information for the current year. Whatever that was paid previously in the previous year that was meant for this year should be dealt with in this current year, so that we can give a true reflection of what really transpired in 2020. Let's say, for example, the income we receive, prepaid income, for example, that was meant for 2021. Then we have to subtract it from the current year, because we want to give a true reflection of what is really happening in 2020. I hope you get that point. Okay, there's all expenses for the current financial period is measured against the income for the said period, irrespective whether it's not yet received or paid. Prudence principle is also stating that profit should not be overstated or understated. Thus, by adding outstanding figures and subtracting the prepayment received in advance, it will ensure that the profit is not overstated. Okay, explanation of accrued expenses and prepaid expenses. I have examples here. What is an accrued expense? Accrued expense, this is a liability. Why? It's because expenses for which the benefit has been received but which has not been yet paid by the end of the accounting period. Expenses not yet paid by the end of the financial period. For example, we have water and electricity amount or bill of 195, which is still outstanding, which is still not yet paid. For example, in 2020, where we are now, we still have outstanding water bills for 2019. That is a liability because we are owing municipality. So that is accrued expense. So what we need to do, we need to add it to our water and electricity bill for this current year so that we can pay it off, so that we won't have these debts anymore. Prepaid expense. This is whereby you are paying your expenses for next year. We are in 2020, but the water and electricity bills for next year, 2021, is already paid. Now, we don't owe municipality anymore, but municipality is owing us. Then that becomes a current asset. An expense which has been paid in advance, of which the benefit will be received in the next financial year, or expense paid in advance for the next financial period. Example, an annual insurance premium which includes a portion of the following financial year has been paid. So, which means we were only supposed to pay for what we have dealt with this year. Therefore, then we have income received in advance. This is where by some of your customer decided to pay you in advance before them receiving services rendered from you. Now you are owing your customers because they paid you, but you haven't done anything to them. So that is a liability. So income received in advance during the financial year, but it's the following year. For example, the tenants have already paid their rent for March during February, which was the end of the financial year or period. Accrued income that is due to the current financial period but not yet received at the end of the financial period. Income not yet received at the end of the financial. Example, the interest on fixed deposit must be received for the last quarter of the financial year. There are people that are still owing you. Your income is not yet received, so that is it. Now, this is something that you need to know and you should understand. This simplified, we should stick to this. To adjust preparing income expenses in general ledger account, because this is the accounting principle, these are the rules, then you should know what to do. Adjustment for accrued expenses and accrued income. To be excluded in the accrued, we are talking about accrued income and accrued expenses, right? Then to be excluded in the beginning of the financial period and to be included at the end of the financial period in order to calculate the current year's expense or income to be closed off to the income statement. You can already see in the income account, number 1, credit positive amount accrued at the end. And number 2, debit, there's a minus amount accrued at the beginning. Why expenses account, debit amount. This is, so when you are going to do the ledger, this information must guide you. Let's say, for example, you are given information, accrued expenses at the beginning, and there's another one, accrued expense at the end of the financial period. So what do? Then I'm saying to be excluded in the beginning. So at the beginning, the one at the beginning, we are going to subtract it. And the one at the end, we are going to add it back. Do you understand? So that is what it means. So have this table with you so that you know when you are going to do this ledger, you know what to do. The same applies to the adjustment for prepaid expense and income received in advance. So the one at the beginning should be included, and the one at the end should be excluded or subtracted from that financial period. Say, for example, income paid in advance. Okay? Income paid in advance. Okay? Then we have beginning, this is 1st of March 2020, the amount was 250. And then we have the end, 31 December, just an example, 2020, that is the end, right? This is going to be, say for example, 500. So what are we going to do when we are going to do our D account? This is what is going to happen. This is going to be income received in advance. So we said prepaid income. Beginning, we include it. Where do we increase our income? On the credit side. So beginning is going to be 250. Then it's going to be broad carried down, or brought forward whatsoever, this 50, and then at the end, this one for December will be on the debit side as 500. Can you see that? Then you can continue with other adjustment. Then that is how it's going to be done. Okay, I hope that one is clear. Balance brought down, and then this is balance carried down on the other side. Okay, then we are moving on. Showing adjustment in the financial statement, income statement. Add the accrued for the current year to the amount given in the adjustment. Subtract all the prepaid. This one is straightforward. In the statement of financial position, accrued expenses under current liability, as I was saying, accrued income under current assets, prepaid expense, that is current asset, income received in advance, that is current liability. I was already explaining these things to you. So the total of the balances are appearing in the statement of financial position as the other receivable or other payables. Now we are moving on to the next issue, which is this is partnership. This is partnership. The topic on partnership. Accounts and financial statement of partnership. Features of a partnership agreement. I just want us to go through theory a bit so that you have an idea. When we are talking about a partnership, we are talking about a business that is started up by 2 or more partners that comes together, contribute capital, resources, ideas, then they start up a business that they were going to run together. So now, what are the features of this capital agreement? Capital to be contributed by each partner. So in the agreement that is needed to be signed by both partners, they need to understand how much each capital, how much each of us is going to contribute to this business. Now we are also going to write down the ratio in which profit or loss are going to be shared, because at the end of the day, we do not want people fighting to say, I contributed this much and then I'm only getting this. No, everything should be in black and white, should be signed. People should agree how much each and every partner is going to benefit at the end of the day. A rate of interest, if there's any to be paid on capital before profit are shared, they must be agreed upon. Rate of interest, if any, to be charged on partners drawing. If there's any partner that is going to withdraw money for their own personal use, how much penalty are we going to charge on them? The rates of interest to be paid on loan. If, for example, there's somebody in the partnership who want to borrow money from the business, how much are we going to charge this person as interest? Salary to be paid by whoever is going to be paid salary, or maybe they are both going to be working in this business and they are partners. How much are we going to be paying salary for this to our members? Arrangement for additional admission of new partners. In case we need to add another partner, there should be arrangement. Everything should be in black and white. Procedure also to be carried out when partners retire or dies. When one of the partner is no more there. All these things are very important. They should be written down in black and white so that at the end of the day, when all this matter arises, we don't conflict with one another. Everything is written in black and white. Okay? Position where there is no partnership agreement. What happens when people started with a partnership whereby there was no partnership agreement? Profit and loss should be shared equally. Okay? No interest is going to be allowed on capital. No interest on drawing should be charged on drawings. Salaries will not be allowed. If a partner invests a sum of money in excess to the capital agreed, he is entitled to interest rate of 5% per annum on such an advance, because you have contributed more than any other member or any other partner, then you are entitled to the 5% per annum. Okay. Now, When we do partnership account, one of the first account that we are going to create, that we are going to work on, is what we call appropriation account. An appropriation account is an immediate account that is created for us to measure, to see how much profit or loss the partnership have made on individual capital account of each partner. The purpose of this partnership appropriation account is to allow adjustments to be made to the net profit income from the profit or loss account before it is distributed to any residual net income is made to the partner's account. This adjustment includes such as partnership salary, interest on capital, partner's capital, loans, and drawing. So that we know that. So this is the treatment of all aspects as per partnership agreement. Interest on capital. This is when partners have contributed money to their partnership, then they need to get the reward for investing money in this business. And then here, we are going to debit interest on capital, and we are going to credit capital. See, capital is increasing on the credit side, the accounting rules. Interest on drawing. This is when one of the partner is trying to withdraw money for their own personal use. So for us to penalize this, is a penalty. We have to charge them a bit on certain percentage, which we have agreed in the agreement when we started all. So we are going to debit capital now because our capital is decreasing, and then we have to credit interest on drawings, because interest is the money we are going to receive because we are charging this. It's like an income to the business. We have to charge these partners. Salaries, partners spending more money, more time working in the business or having more responsibility are compensated for this by giving them a salary, and then salary is gonna be debited, and capital current account gonna be credited. Interest on loans. Say for example, somebody from the partners borrowed money from the company, from the business. The interest that this person is going to pay on this loan is normally expenses to the business. In this case, it's a company that is borrowing from a partner, so that's why it's an expense. Don't get confused. So, interest on loan with accrued figure, capital is also on the other side. Okay. Importance of current account. The current account, this is an account for individual partners. So whatever money or spending they're getting or they are paying out, they also have their own account. Using the fixed account, capital account format, any changes in the capital resulting from profit or drawing are shown on the partner's current account. This is the partner's current account. As you can already see on the credit side, this is the personal account for a partner, one of the partner account. So balance brought down on the credit side. The salary that they get is an income to them. Partners' interest on drawing, because on capital, because they have invested money that they are getting a return from their capital. It's on the credit side. Interest on partners' loan. Maybe they have loan a company, the business, the loan. And then on the debit side, this is what is taking from the account, like debiting, like subtracting. Balance brought down. Maybe it was in areas. It's in an overdraft, partners' drawings, partners' interest on drawing, etc. This is subtracting from their account. What is the goodwill? A goodwill on admission a new partner. When we are admitting a new partner, the incoming partner should bring in some other amount as his share of goodwill to compensate the existing partner for the loss of their share in the future profit of the business. Goodwill is the excess amount that has to be paid to acquire a part of the whole business as a going concern over and above value of the net assets. So, in other words, when we are talking about a goodwill, we are talking about a goodwill is an advantage a person gets by continuing to carry on a business which had already carried on by the previous owner. So the benefit is always called intangible asset, because you can't really see it. Say for example, you occupy a place which was already previously owned by somebody who was very, very successful. So now when this the reputation, the image of the business that was previously owned by somebody else, you have to carry it on, and then that's how your business is going to benefit from somebody else's reputation. So this is the goodwill. So it's something that you can't see, but it's something that you can measure in your financial books. Reasons for goodwill will be reputation of a business, number of regular customer, experience of reliable staff, location of the business, contact with suppliers, products and services provided by the business, experience and efficient workforce, possession of brand names and trademarks. Then how do we treat goodwill? Depending upon the share of capital to be given to the new partners, either a sum of money will be directly paid to them, to him, to the old partners through the business, or privately. After recording new partners' capital, new partner's capital account will be debited with his share of goodwill, the credit being given to the old partners in the ratio of their sacrifice of future profits. Then the continuation of goodwill continues. When you admit a new partner, you need to vary goodwill and compensate partners, because a new partner joining an existing business will benefit from the goodwill built by the original partners. Any partner that will be given change in the ratio will have to pay for this share. It's just a repetition. Okay. This is partnership dissolution. When we are going to disclose our, we are destroying. We want to end our partnership agreement. What happens? Okay. The asset excluding the bank, only the bank is the only one which is going to be remaining. Otherwise, all the accounts are going to be destroyed. So close all assets except for bank. Okay, close off all the assets with the net book value. Remember the net book value. We are going to debit realization and credit asset, because we don't want asset anymore. Proceed money received from disposal, we debit bank, and then we credit realization. Asset taken by a partner without payment, we debit capital, and then we credit realization. So these are their liability now. In case their liability, we have to pay creditors with discount received. All this information are given to you. This is just a table that is giving you information on how to treat all this information. Creditor taken by the partners, what we do, debit creditors and credit capital. Okay, this is capital. Transfer any balances in partners' current account to partners. This is how it's gonna be done. Okay. What else? So when you are recording profit on realization and divide it between partners in their profit sharing ratio, we debit them. But when you are recording loss on realization and divide it between partners in the profit sharing ratio, we credit them. So amount received from partners or paid to partners upon dissolution, any credit balance in a partner's current and capital account combined represent the amount which can be withdrawn from the partners by the partners on dissolution. Any debit balance in the partner's current and capital account combined represent additional cash to be paid by the partner into the partner's dissolution. Okay. Now, we have come to the end of the presentation, but before we end, I just quickly want to highlight a few things on the exams, on how we are going to prepare and get ready for our exam. This paper is out of 150 marks. 140 marks. It's a short paper question. Where and I'm advising you, if you can get hold of the NANCO X module material to practice and to prepare for your exam, it will be useful, especially module 1 and some topics of partnership and departmental account in module 2. So use the NANCO X module for both module 1 and 2 for you to prepare for your exam. So there's nothing really difficult about this whole module. Practice makes perfect. All you need to do, you just need to consult your books, give us a call if there is something that you don't understand, and then we can always be able to assist. And then all the best in your exam. Prepare and study hard, and have a nice day.